Everybody got their coffee, etc.? Good. Okay. Good morning. Thank you all for coming. This is apparently my week for state tax conferences, and I must tell you, I'm having a ball. So this is a good close to the week. Welcome to the latest in the Tax Analyst series of discussions on key issues in tax policy and tax administration. Today's topic is about the Multistate Tax Commission's rewrite of the Uniform Division of Income for Tax Purposes Act, also known as UDITPA. Let's see how many times I get that wrong today. I'm Chris Bergin, the president of Tax Analysts, which is a nonprofit publisher of State Tax Notes, State Tax Today, Tax Notes Today, and Tax Notes International, and many other fine print and online products on federal, state, and international taxation. We are in our 11th year of public discussions on tax policy. If you are new to our discussions, let me say it's great to have you here. Let me take just a moment to explain our process today. I will open things up with some brief remarks to introduce our topic. I will then introduce our distinguished panel of speakers. Each of them will address aspects of our topic. After that, we will open up the discussion to all of you, and we encourage all of you to participate. We are streaming live video of this event on our website, and that explains the camera in the back of the room and the lights in our faces. So I want to welcome our virtual audience as well. I believe this is the largest one we've had to date, so welcome. We will also post both the webcast and a transcript of today's event next week on our website. That's taxanalysts.com. For all media purposes, we are on the record. There's media in the room, at least from Tax Analysts. For that reason, when I recognize you, please tell us who you are, or I'm going to have to interrupt you and ask. Once I call on you, we will quickly get you one of our handheld mics. We're also live tweeting this event at hashtag UDITPA as we reach more people beyond this room through social media. We invite our listeners to send us questions via Twitter. Just tweet at the hashtag UDITPA. We hope to hear from you. I will moderate the discussion, and we will end at 11. Before we begin, I wanted to mention that we've recently released a web series of informational videos on our website and YouTube channel. The videos will be available regularly, and we'll include several of our experts who will discuss various tax topics. Our goal for creating these videos is to discuss complicated tax issues, hopefully demystify them a little bit, and provide unique insights into our tax system. So we ask you all to check it out. Now on to the subject at hand, the MTC's rewrite of UDITPA. The Uniform Division of Income for Tax Purposes Act, or UDITPA, was developed by the Uniform Law Commission in 1957. It was intended to address one of the most fundamental but complicated features of state corporate income and franchise taxes: the division of the tax base among the states in which a taxpayer does business. UDITPA provides a model formula for apportioning a multi-state corporation's tax base. 10 years later, UDITPA was incorporated nearly verbatim into the Multistate Tax Compact. Article 4 of the Compact provides an election for taxpayers to apportion multi-state income pursuant to state law or an evenly weighted three-factor formula. UDITPA has been enacted in whole or in part by over half the states. But in the past 56 years, times in the economy have changed. UDITPA, however, has remained a constant. It is a reminder that all legislation, even model legislation, has a natural lifespan. The prevalence of UDITPA's provisions has slowly been eroded as states have moved away from two of the Act's major provisions: the equally weighted three-factor apportionment formula and sales factor sourcing for services and sales of intangible property. This has led the Multistate Tax Commission to consider whether the model statute should be rewritten. In 2009, the MTC's efforts to have the Uniform Law Commission undertake a rewrite of the model statute was defeated, but the MTC was not deterred and continued its efforts to rewrite UDITPA independent of the Uniform Law Commission. Currently, the scope of the rewrite is focusing on 5 areas: a revision of the definition of business income, language revising sales factor sourcing of services and intangibles, recommendations that the UDITPA apportionment formula be switched to a double-weighted sales factor, narrowing the definition of sales, and revising the section on distortion relief. Professor Richard Pomp, one of our distinguished speakers today, served as the hearing officer for the two-day hearing on the rewrite, which took place in March. The result of that hearing is the report, which has been made available to each of you today, hot off the presses. If you didn't get one, there's plenty outside. Please take one or two if you want. The report makes recommendations regarding the rewrite and presents a nice backdrop for our discussion today. Of course, the MTC does not have to accept the report in its entirety. It could accept some or all of the professor's recommendations before determining how to proceed. So, today we will discuss why the MTC decided to undertake the rewrite, the recommendations from the hearing officer's report, and what the most important considerations are. To do so, we have put together an excellent panel, truly excellent, and I'm pleased to have them here. I will introduce them in the order in which they will speak. Richard Pomp is an Alva P. Loiselle Professor of Law at the University of Connecticut. Shirley K. Sicilian is the General Counsel at the Multistate Tax Commission. Prentiss Willson of Counsel at Sutherland, Asbill, and Brennan, LLP. And Arthur R. Rosen, who is a partner at McDermott, Will, and Emery, LLP. Thank you all for being here. Professor, would you walk us through the hearing officer's report?
Chris, for making this happen. And I thank Kara Griffith for being there at the early formulation of this idea, and Jenelson and your Crackerjack production staff for turning this around in a very short time. This is very nicely done. We have not seen this, obviously, until today, so references to pagination may will take a while to try to figure it out. Since everyone has this version and not any other, we'll have to try to coordinate. It's nice to see everyone here. A lot of my former students are here, and of course a lot of the people who participated in giving me feedback on this project are here in the audience, and they know how much I appreciated that. This hearing was a little different in that Joe Huddleston, who's sitting in the audience, Executive Director of the Multistate Tax Commission, and Shirley, General Counsel, really encouraged more of an outreach than I think is typical of some of these hearings. And so, as you can see from the acknowledgement section on page 5, an awful lot of people were not bashful. We have, in the state tax field, we have enormous intellectual firepower, but more than that, there's such a spirit of camaraderie and being in an extended family that I have not seen when I go to some bar meetings and on federal tax, that we really are blessed with a lot of people that are willing to take off their practitioners' hats and put on their public policy hats and maybe gently put aside the interests of their clients for the greater good. And I just want to acknowledge them as I did on page 5. Chris, I think for the background, I'm going to turn it over to Shirley that will explain how the MTC even got involved in. After all, there was a Uniform Law Commission Act. So.
I'd be happy to. And Chris actually went through quite a bit of the background, but I think that's the question. Why the MTC? Why is the MTC doing UDITPA? And it's the MTC, Joe Huddleston, in 2006 wrote a letter to the Uniform Law Commission recommending that they review their model UDITPA. As Chris pointed out, the model was put together 57 or 56, I think now, years ago. And times have changed. Not just the economy, but also states' policy choices have changed. And so what we're seeing is states moving away from UDITPA. And they're mostly on main provisions. They're moving away uniformly, interestingly, but not on all the provisions. And so as they move away from these provisions of UDITPA, our thinking at the MTC was that a model revisions to UDITPA would give state legislatures something to draw on as they modernized their enacted apportionment provisions. So that's our goal. We also didn't want to, because UDITPA, it's 56 years old, but it's held up remarkably well. And so our thinking was to pick out those provisions where there really are problems, the provisions where there's a critical need for change, and do a surgical strike, focus solely on those so that we can get something done. It took the ULC in 1956 decades to get that original act. And so our goal is to try to do something maybe in just one decade. And to do that, we thought we better focus on just the 5 provisions. The other thing to keep in mind, I think we all have to keep in mind, is that we're not going to come up with a perfect rule. We know that what we're looking for is the best rule, just the best rule for the times. It's not going to be perfect, but we want to find the best rule that will fit most taxpayers in most circumstances, so that we're not relying on ad hoc distortion relief as much as perhaps we are now. So those are the goals, and that's why the MTC undertook this. It's appropriate that it went to ULC because UDITPA is the ULC's product. But there was, after quite a bit of controversy at ULC, where folks actually argued that uniformity is not desirable or it's not practicable, the ULC ultimately decided that it wouldn't take this up at this time, although it might if a consensus were reached later and people wanted to deal with it. So I think that happened in June of 2009, and 1 month later in July, the MTC Executive Committee directed the MTC Uniformity Committee to take a look at those 5 provisions and recommend amendments. The Uniformity Committee did that. We have the models that were sent to public hearing. Rick was the hearing officer. And I also want to mention that back at ULC, Rick and Prentiss had been identified as the drafters for ULC, the ULC committee looking at this. So when the MTC first took on the project, the MTC asked Rick and Prentiss and also Charlie McClure and Michael McIntyre to come and speak to us about what they see the issues are with those 5 provisions, and they did. So in a sense, they kicked off the project for us at the MTC. And now Rick has acted as our hearing officer. We have the report, and Chris ran through what the next steps are. I want to add the next steps being that this report goes to our executive committee, and our executive committee will decide whether to take Rick's recommendations or not, and whether to stick with what we have recommended or not, or do something else after hearing from all the public comment and Rick's recommendation. But once we have something, once we have a model statute that the MTC has approved, then the next step will be for the Uniformity Committee to draft model regulations to go with that statute. I think we recognize that this is a statute, it's at a high level, and we're going to have a lot of work to do after this, developing regulations. So.
Just a word about the Uniform Law Commission. There was a very well-orchestrated business pushback. Shirley was very kind, I think, in her description of what happened. It was nothing more than really a crumbling of the Uniform Law Commission in response to a well-orchestrated lobbying effort. And that's why they abandoned the project. It cost the MTC dearly because the MTC quite appropriately held any of their projects in abeyance while the Uniform Law Commission was going to go forward, and what it cost probably 3 years. And during that time, states continue to move, especially with market-based sourcing, and have taken positions that are inconsistent with what the MTC is recommending. And so those 3 years, I think you were quite right in holding your project in abeyance, but it cost a little bit in terms of leadership in this area, and so there's a little bit of catch-up now. Chris, can I invite the panel, just kibitz anytime they want, as well as the audience?
Absolutely.
Yeah.
Yep.
because this really is sort of issue by issue, and I think it'll just be useful if after each issue we can open it up. So,
you know, Rick, your term crumbling of the Uniform Law Commission could be seen a different way. Maybe you're saying, democracy works, isn't that terrible? So I think there's another side of the coin that maybe it showed that the public, through the business community, which is part of the public, was able to convince elected officials of another view of the situation.
I would say when Prentiss and I met with them on our first day, we said to them, this is not the Anatomical Gifts Act, and you are going to be in for serious opposition by the Fortune 500. And they said, no problem, we have a backbone. And when they found out that their budgets may have been under attack in various state legislatures, they decided to re-examine the project. So democracy at work, sure. If lobbying is part of democracy, democracy at work. So, all right, we'll take the first recommendation, and that is the apportionment formula, which really is not a recommendation as much as a suggestion, I think. And the suggestion was for the double-weighted sales factor. But states are free, as I read it, Shirley, states are free to do what they want, and they will not be inconsistent with this recommendation.
In fact, the recommendation is actually that states choose their own policy with respect to the weighting, but then there's a recommendation that a reasonable choice might be the double-weighted sales factor.
And at the Uniform Law Commission, there was some sentiment that, boy, if you can't get agreement on the formula, you might as well abandon the project, because the formula is really at the heart of uniformity. And I think it's somewhat of a romantic view, because even in 1957, there were a whole bunch of specialized industry-specific formulas that coexisted with, at that time, the evenly weighted three-factor formula. It turned out in 1957 we were a manufacturing mercantile economy, so the evenly weighted three-factor formula probably covered more of the gross domestic product of the country than did the specialized formulas. But over time, as we shifted to services, it seems to me the specialized formulas came to cover more and more. And I think there's a paper, Elliot Dubin from the staff of the MTC's in the audience, and he did some work published in State Tax Notes, Chris, which sort of documents this shift. And so I'm really not all that concerned with what the apportionment formula is today. I also think it's irrelevant what the MTC says, that the evenly weighted three-factor formula did not stop any of the states from moving to double-weighted and then single-weighted. It may have had some restraint, but hardly, when you look at the numbers, it had a significant impact, since three-factor evenly weighted is minority view. And double-weighted, I think double-weighted is a fine compromise. There's no science to the apportionment formula. There's no economic model, and nothing that tells you what the right answer is. And that's unfortunate in part because what it meant was that states, under lobbying by business, started using the apportionment formula as really a non-transparent way of reducing the state corporate income tax. And that accounts for the double-weighted sales factor and now the single sales factor. I don't think any states adopted single factor because they thought normatively this was a great improvement. I mean, how can you say that capital and labor has no input into the generation of income? It's only sales. I mean, in 1957, there was a sentiment we shouldn't even have a sales factor, that it should all be capital and labor. So we, without a model or without any kind of theoretical defense of the evenly weighted three-factor formula, it was hard for the states to resist lobbying by business that they should move to a formula that encouraged business to locate in their states. And that, of course, is what double-weighted does compared to evenly weighted, and it's what single-factor does compared to the other two. And so I think whenever economic development clashes with good, sound tax policy, you bet on the former and not on the latter, and I think that's what we're seeing. But
So you have three comments I would have.
Add a historical footnote, because it wasn't just specialized industries that had, of which there was a great variety back in the 50s, but the regular formula among the states, there were 8 or 10 different formulas, some of them relying on 5 and 6 factors. So certainly coming into the adoption of UDITPA originally, it was just a mishmash of formulas for basic mercantile and manufacturing businesses themselves. So we have certainly improved on the situation. We've lost ground, I guess. We grew up kind of at the time of Mormon, when only Iowa was out of step, the only one with single factor sales, and everybody else by this time essentially had equally weighted. And we have seen, if you started out kind of in that time frame, you got used to the idea that equally rated makes all the sense there is, and we have been watching that get eroded away for the reasons that Rick has described.
I think one of 3 observations. The first is maybe the MTC had an opportunity to really exercise some, let's say, leadership in this area by not just following. And I think you'll see that something that pervades the entire proposal is, well, states are doing this anyway, so therefore, let's see how we can help out, rather than saying what really is correct tax policy or correct economic policy. The second idea that if, in fact, you're going to have non-uniformity in the formula, why even worry about the details of how you compute each factor that may be or may not be in a formula? And it seems to me that if one of the goals is to make sure that businesses pay tax on no more than 100% of their income, that can only be met if you have more uniformity in the actual formula. So the hackneyed cliche about your rearranging the chairs on deck of the Titanic, I think, would apply in this situation. Finally, mentioned there's no scientific way of constructing an appropriate or perfect formula. Well, that's true. It can't be perfect, but I think we all can see, for example, in all the testimony for the Willis Commission, and most economists, except for one, I think, will say that the idea of an income tax is to pay the jurisdiction that supplied the resources that allowed the business enterprise to generate its profit. And therefore, that's why traditionally, and the legislation introduced in Congress in the 60s and in the 70s had only property and payroll factors to represent labor and capital. And as we all know, the receipts factor is just there in the first place in order to get uniformity, to buy off the market states. So I think if those principles are kept in mind, you can get it closer to what is appropriate. Forgetting about what the U.S. Supreme Court said about the benchmark, because again, that's saying what's happened, not what's right.
And an observation, keying off of what Art just said, is I think you can think of apportionment formulas as being on a continuum, where at one end, the formulas reflect more of the activity of taxpayers that contribute to the earning of its income, and at the other end, the formula reflects less of that activity. So the no formula reflects all the activity of the taxpayer that contributes to its income, and it's interesting to hear there were states that had 6 factors. Even the 3-factor formula doesn't reflect all the activity. The property factor doesn't include intangibles. The payroll factor doesn't include contributions from independent contractors. So even the 3-factor formula doesn't reflect all activity. The single sales factor is down here at the narrow end of that continuum. And I think the U.S. Supreme Court has said that as long as a formula is not intrinsically arbitrary, that it will be accepted, and accept how it applies, how it's applied in a particular situation. And the less activity that's reflected in that formula, the more likely that when it's applied, it will not reflect a particular taxpayer's activity in a state. And so the more likely you're going to end up in a Section 18 distortion relief situation. So the idea is with single sales factor, you're probably, although it's not intrinsically arbitrary, the U.S. Supreme Court has blessed it in Mormon, but it's more likely to lead to distortion in particular cases, and you'll just see, the states would see more resort to Section 18.
Let me clarify one thing. When people say that Mormon was where the U.S. Supreme Court blessed a single factor formula, remember that the Supreme Court specifically said there's really a failure of proof. and that issue was not raised until the appeal. And a lot of people believe, therefore, based on that case and language in Hans Rees, that if a taxpayer were to show how its income is earned, show that it was labor and capital earned income, a single sales factor might be unconstitutional. And that proof just wasn't there. I think it's true that the Supreme Court will never dictate a specific formula, but one that totally ignores certain inputs, I think, is really subject to some exposure there.
I think so, as applied.
All right, a couple of reactions. I think we have to apologize to the MTC to say they were unconcerned about correct tax policy. I don't think that's true at all. I think they're very concerned about what the theoretically right answers are. They also have good political instincts about what can be done and what can't be done. Their goal is not to write, we wish the world were this way. It is to deal with the world and try to accept that and what makes sense within those political constraints. Uniformity, full accountability. We don't have the same tax base among the states, and we don't have the same definitions, business income, non-business income. There's a whole lot of ways in which the states aren't identical. And to really have full accountability, you really are going to have to worry about a much broader definition of uniformity, in which case you lose the whole project at that point. So I would, were you arguing for two factors, property and payroll? I mean, that's interesting. I think it might be an improvement. I also, in an earlier draft, raised the possibility of whether there would be a shift in tax revenue if we went to just payroll and property, because I think the sales factor's got serious issues that surround it. And so I raised that. There's no good answer to it, so I never pursued it. But it's a very interesting, I think, question. If we went to two factors, would there be a major shift in revenue or not? The market states think they provide a resource. So if that's your theory of the corporate income tax, that it ought to somehow recognize the resources provided by a state, the market states think that's what they do, and that's why they have a sales factor. In terms of Moorman, I think probably the taxpayer ran separate accounting numbers, and they weren't impressive, and that's why it's not in the record. I also think Moorman's coming on the tails of Butler, where there was separate accounting, and you remember Justice Douglas' famous statement, we don't have to impeach the integrity of the taxpayers' accounting records to say it's not adequate for state tax purposes. I'm unimpressed. It could be read as a failure-proof case, but I don't think it is, and of course the court has shown itself really quite unimpressed by separate accounting, as evidence in Container. Exxon, where you had very good intra-corporate divisional prices. So, but there could, as applied, I think, under the right facts, we have two distinguished practitioners here. I bet you would make a good son of Moorman argument. So,
I just think two comments. To ask whether I support the two-factor. I'm just saying that Congress, after a year or 2 years of hearings, thought that was the appropriate way to go. And my understanding is, and I wasn't born until 1980, so it's all before my time. But the reason so many states ran to adopt UDITPA or variations of UDITPA was to stop that legislation from being enacted. So I think that's important to keep in mind.
yes, this, I mean, after Northwestern Portland Cement was won by Minnesota in 1959, the business community went apoplectic. They just couldn't believe the Supreme Court would allow a state to tax interstate commerce. And they ran to Congress for relief. Now, Prentiss, you probably testified at the Willis Committee.
I did.
So you remember those days. And the states realized they better get their act in order to keep Congress at bay. And that's what really led to the Multistate Tax Compact and the Uniform Division. It was an attempt to really say to Congress, there's no need for you to intervene. And as the more time went on, Congress's attention span being what it was, they moved on to other things. And so now with the Marketplace Fairness Act, it may be the first time in recent history Congress will really intervene in a serious way in state taxation. But Okay, then Shirley put equitable apportionment on the table in her
Rick, can I
comments.
interrupt you for just a quick second?
Sure.
I hate to mess with the flow of this because it's great, but this is a little different than where we usually do it. Anybody has a question, so if it's okay with the panel, please raise your hand, and I'll get you in on the conversation, okay? All right. Sorry, Rick.
Okay.
Okay.
Where is there a
There's a
question?
question.
I can't see.
You already have he's got
We already have a question.
he already has his counsel here. You're represented by counsel, Joe. No, go ahead.
I would like to make one brief comment about what our
Microphone, Joe, you have to tell us who you are.
Joe Huddleston, Multistate Tax Commission. I think I've heard often reference to the Congress's intent through the Willis Commission, and I think it's inaccurate to suggest that Congress wanted a two-factor formula. You have to keep in mind a couple of elements. One, this was merely a commission established by a committee of Congress. It was a commission that heard testimony from 100 manufacturers, and their recommendation came in 1962. The relationship to what's happening in business in 1962 and what's happening in business in 2013 is a world apart from reality. Either then, and certainly today, Congress never acted on this, nor would I suggest to you they ever would have.
Can I bring it back to the current times and the single-factor sale and whether it works? At least I think it's worth mentioning the example that I get from Ben Miller, a very distinguished, long career at Franchise Tax Board, recently retired, and very, very active with the Multistate Tax Commission. And even Ben has been saying of late, he has an example he uses a lot, which seems crystal clear to him that single-factor sale would not work, and that's an integrated oil company with exploration and production in one set of jurisdictions and refining in another set, and then now ultimately marketing in a third state. Of course, that is essentially the fact pattern of Exxon, because that's all they had in Wisconsin, was marketing in Wisconsin. But Ben would be a very effective advocate with a long and distinguished state career on behalf of a taxpayer who decided to challenge the single-factor sale in that kind of a factual situation. I certainly think he is correct in that regard. So I don't think we're going to get away from Section 18 challenges. I think people are getting more sophisticated at making them. They're expensive, whether Mormon was a burden of proof problem or not, why it's a mistake that taxpayers are much less likely to make today. And so that's not going to be the way out, and courts are going to have to decide, gee, that how rough can the rough justice be?
I mean, the hypo you gave isn't so different from Moorman manufacturing in one state and basically selling in Iowa. So.
Yeah.
All right, Shirley, you want to tee up Section 18?
Sure. Well, and this discussion about distortion being created perhaps by a narrow set of activity in the apportionment formula tees up Section 18 nicely. And also, as the rule gets further away, as Joe said, as the rule gets further away from the economic reality of the day, the more and more likely that old formula isn't going to reflect the taxpayer's activity in the state. So the more likely you're going to need to use Section 18. Hopefully, with some of these revisions to the model and the states adopting those revisions, hopefully, that will relieve some of the pressure on Section 18. But even if it does, times will continue to change, and there will always be a need to fill regulatory gaps that just aren't there. And so will probably always be a need for distortion relief, and particularly distortion relief on not just an ad hoc basis, but also on an issue-wide or an industry-wide basis. By long-standing practice and regulation, long-standing regulations, the MTC has always interpreted the UDITPA to grant not just ad hoc distortion relief authority, but also that distortion relief authority through regulations. The statute could be clearer, though. And so the purpose of our Section 18 amendments is to make that very clear in the statute itself and not just in regulations, that the The tax commissioner does have the authority to cure distortion on an industry-wide or issue-wide basis through regulations, uniform regulations that apply to all taxpayers in those circumstances. And then there's a second piece to it, just to be clear, that ad hoc distortion relief is available even to taxpayers that fall within those special industry regulations. So that's really the goal of our Section 18 changes.
And people do shorthand Section 18 with distortion or gross distortion. Nowhere in Section 18 do you find those terms. I've avoided them in the report. The language says that if the apportionment provisions do not fairly represent the extent of the taxpayer's business activity, then the taxpayer can request, or the tax department can impose, some other approach. And while Section 18 lists other approaches, there is a residual rule which really, as long as what is done is reasonable, you can do anything you want. But we all call it distortion. I have no problem with the regulations. I think that's a great idea. The language of UDITPA doesn't necessarily lend itself to that interpretation. I think they've done a fine job of clearing that up. I like regulations. My whole philosophy, as you'll see in the report, is we ought to be doing more things industry specific. That in the abstract, it's almost a hopeless task, and we'll see that when we get to Section 17. That you got to concentrate on industries, and the MTC has done, I think, a marvelous job of working with industry, and has a whole bunch of regulations, and I encourage the MTC to continue to do that. I added a bunch of things in my redraft of Section 18 that I think belie any notion I am shilling for the MTC. I have received comments accusing me of shilling for the MTC and accusing me of shilling for big business. So I am reminded of that person you study in math class with 1 foot in ice water, 1 foot in boiling water, and on average they're comfortable. So, so let me just tell you what I have added and get the reaction of the panelists. We do have an issue. Who should have the burden of proof? If a taxpayer is requesting alternative apportionment, I think it's perfectly appropriate that the taxpayer have to defend that request, and I don't think that's controversial. What is, I think, controversial is I said that if the state is invoking Section 18 and is telling the taxpayer they should be on a different method, they can't just follow the statute, I think the state should have the burden of proof. I think that is consistent with the near consensus of the courts that have dealt with this. Not entirely. We've had a recent case that said the opposite. I think it is consistent with American jurisprudence, and I'm not going to bore you with the principles I lay out in the report. I'm trying to find what page in this, I guess page 20 to page 22, makes the case that putting the burden on the state tax department when they invoke Section 18 would indeed be consistent with what we do in general in our legal system. Maybe we should stop there and get some reaction, because I think you
make one fundamental point, which is that this is what you actually did before you get to the ancillary comments is easy and very straightforward and maybe wasn't even necessary. I've been surprised in the 43 years I've done this that, as far as I know, no one has ever challenged whether the state had the authority to enact a regulation for a specialized industry. I keep asking, and once in a while I hear some rumbling that maybe someone has. I've invited taxpayers who don't like the result, gee, we ought to challenge, because there is definitely some question whether the states had the authority. So that ought to be cleaned up so there isn't any question, and that's what this does, and that's perfect. I agree completely on the burden of proof. Of course it should be on the state if they are the ones that are seeking a change under Section 18, and I find it almost appalling that there are states out there taking a different point of view, hiding behind the normal presumption that what the state does is right and the taxpayer has the burden of proof to overcome the state's action. But that shouldn't be the case when the state itself has invoked Section 18.
Yeah, I apologize for being a purist again, but it seems to me as far as industry regs go, that is such a macro major change that the legislative body really should do that. I don't think it's appropriate for regulations to affect the entire industry when that's why we have the elected officials again. I think the executive branch is going too much. But again, the ship has already sailed as far as that goes, as you've noted, so maybe nothing can be done. But I think if we really wanted to see what's right for the legislative branch, what's right for the executive branch, maybe to do definitions or fill in the holes, that's fine, but not to set up a whole new apportionment scheme that will affect an industry. As far as ad hoc or company-specific variation, discretionary authority, I think that it's essential, and we've had this come up in a few cases, that the revenue agency has to implement the legislative underlying scheme. So for example, if the legislative scheme, the standard apportionment formula, is to reflect from where the resources come, labor and capital, or the opposite, suppose it's where the market is. The alternative that's being suggested and implemented by the Department of Revenue should reflect that. So for example, if the standard formula says you look at property and payroll, I think that discretionary authority is there when the property can't really be valued because there's no fair market value for it, it's hard to determine, there are comparable sales, so you do some other type of way of valuing the input that comes from that capital. But to say that, well, we can't find it's not right to use property and payroll in this situation, we're going to use sales as an alternative, is in other words, turning the legislative scheme, the underlying philosophy of the tax statute on its head is wrong. So I think that should always happen. And remember, discretionary authority in the current statutes talk about if the standard formula doesn't reflect the taxpayer's activities in the state, then an alternative can be implemented. So you would think, therefore, any implementation of discretionary authority will still have to reflect taxpayers' activities and not say, well, we're going to disregard that totally and go to the market. The final issue on burden of proof, I think I agree totally. The party that is seeking to deviate from the standard formula should bear the burden of proof. And I think it would be helpful if the statute set the standard for the burden, exactly what has to be shown and whether, and this next point pervades everything we do, whether it should be clear and convincing or just preponderance. That'd be very helpful in a lot of these cases.
I'd like to respond to a few things that Art said, and then also Rick and Prentiss, but that in terms of what the rule is focused on, it is the taxpayer's activity in the state, no question. And the activity can be market activity. That's what the sales factor is supposed to represent. So, so I do think it's valid that if there is sales activity in a state, and yet the formula is not reflecting any of that for some reason, then that may be a situation where there needs to be some alternative formula in order to reflect that market activity in the state. Then on burden of proof, I don't think it's an obvious question on whether the state should ever bear the burden of proof. And the reason I don't think so is because Prentiss mentioned it. Prentiss said that the general rule when it comes to tax jurisprudence anyway is that the tax commissioner has some degree of deference allowed to the tax commissioner for its determination of tax liability. And the determination that there's distortion and an alternative rule should apply is really just one of the parts of making that determination of tax liability. So the question is then, is that different from the other parts of determining the ultimate tax liability? Is it special for some reason, that piece of the decision on distortion? And I think that's where you see some courts saying, yes, it is special, like in CarMax or Media General in South Carolina, or some courts saying, no, it's not special. It's just like the rest of the determinations, like we saw in the Equifax case. So the next question then is that fair to reach a result like Equifax and to place the burden always on the taxpayer? And I think the court in Equifax, and some might argue that it is because the taxpayer has all the information. The tax commissioner doesn't, but the taxpayer has all that it needs in order to rebut that deference. So I think that's the idea behind the alternative view of this issue. But aside from right or wrong, aside from the question of who should have the burden, I think there's a question of whether burden of proof specification really belongs in a model uniform act. I think the Uniformity Committee actually considered that. This is an apportionment provision. And burden of proof really, of course, isn't about apportionment, but it's also, is there a need for that to be uniform across the states? And why pick out this one piece of the Model Uniform Act and identify the burden of proof in that one piece, Section 18? So I think those are the questions that I think are relevant for deciding, for thinking about this issue.
Oh, we have a question, then I can respond.
Thank you. Joseph Malka, United States Tax Court. I'm a tax clerk there. I was wondering, in Section 18, I think one of the problems, but also one of the benefits, is that it's a little bit more ambiguous of all of the parts of the MTC or UDITPA. And I was wondering if you thought that maybe there could be something like an AMT in Section 18, or alternatively for businesses, if they, let's say, had taxable income more than 20% of whatever factor it is, the 3-factor or whatever you think the medium should be, that maybe the burdens should switch if they're above that threshold. I just think the business community would like more certainty, and I think that would bring it. Thank you.
I guess Dan Bucks has suggested something similar. I don't know if it's in a state tax notes piece or not. I would think there's merit to what you're saying, and this would be very fit for regulations to take that kind of approach. And I would hope that should the MTC draft regs, you might take that kind of approach. In response, I have a bunch of random thoughts, which of course are all the thoughts I seem to have at this age. But if the state is invoking alternative apportionment because it knows what the industry looks like from tax returns that are confidential and known only to it, and they say, well, based on our metrics, you're way out of line, we're going to put you on a different method. I don't know why the state shouldn't have to defend that and put its cards on the table and have to prevail, showing that that's a reasonable approach. So I just think that there are situations where the taxpayer doesn't have the information. Where it does, sure, the taxpayer ought to come forth and put its cards on the table. No one does oppose the regulations. I think some do, but in general, the regs have been worked out with industry. So it's kind of, industry has been at the table, quite appropriately so, and this is the MTC's philosophy, and it's quite appropriate that we get the industry under the tent and we hammer out regulations, and no one really has an incentive to say, oh, well, those regs weren't within the power granted under Section 18. Art does raise a legitimate issue. Should things be done by statute? Should they be done by regulation? Page 18 of the monograph you have in front of you discusses that view. I think in the end, every state tends to have its own culture and tradition and milieu as to who does the drafting. And there are some states where it is done by the legislature and others where the tax department does it. There are states like Connecticut where a legislative committee has to endorse regulations done by executive branch agencies. So that gives it sort of a quasi-statutory feel. With the Administrative Procedures Acts, I think taxpayers get a lot of input at the administrative level, and so I am not really concerned that somehow they'll have more input in if the legislature did it. And I guess finally, if a legislature is unhappy with the regulations, you could count on the business community or the affected parties making their discomfort known to the legislature. So in the end, I think it's a close call, but I think you kind of do with whatever the culture of that state has been. In terms of Art's point, he would like to see what the standard should be. more convincing than not or whatever. You know, we have a whole bunch of standards floating around. As Shirley said, I was sort of pushing the envelope by even putting this on the table because it is viewed as a procedural issue. I happen to think that procedure counts if you're trying to encourage uniformity. But traditionally, procedural things have been viewed as, well, what does that have to do with apportionment? I just think the two do go hand in hand. You want things to come out the same in each state. And so I'm a big fan of getting procedural things into UDITPA under the guise of saying, well, these are ancillary to your goal of uniformity. But I was already getting enough pushback, and so it would have been dead on arrival if I tried to tell a state what standard they should impose when they have their own standard. So that's why, if you look at the drafting in square brackets, states should fill in their standard.
You know, I want to comment on that about this uniformity in everything, procedure also. Also relates to the comment we just had from the audience regarding a safe harbor. And one thing that I think some people would be surprised to find out is a lot of major corporations care sometimes even more about the administrative part of their tax function and the efficiency of getting returns and knowing how much is due than they do saving tax dollars. And I think that a lot of people lose sight of that. And we had some major clients that are willing to pay more every year if it's simple to administer and they know definitely there's not going to be any audit exposure. So I think we've got to balance those two all the time.
As difficult as it is to support art, I want to
golly gee shucks.
Second that with an example that's kind of outside of this, but Massachusetts just went to combined reporting a few years ago, and they also did something which I think is wonderful and have been urging California to do in order to avoid the threshold problem with combined reporting of determining which entities are in the group and which are not. They adopted also an elective consolidation format. And I was just on a panel with Mike Vitale from Department of Revenue in Massachusetts a couple days ago, and he pointed out that 30% of the taxpayers, the big taxpayers, elected the elective combination. And I think that underscores Art's point. I mean, some of those people are people who undoubtedly didn't benefit from that as opposed to taking the aggressive position of, well, I'll decide which entities ought to be in and which entities should be out in order to achieve certainty. And I've had exactly the same experience with a lot of companies. So anything along the way here that encourages that result will be helpful.
Shirley put Equifax on the table, which opens up another area whether a taxpayer should ever be penalized for following the statute. And in the interest of disclosure, I worked on this case, but I hope it won't affect what I'm about to say. Here you have a company that basically, well, initially they screwed up and then they file an amended return. The amended return follows the statute. And Mississippi has regulations issued by the department that basically say, we're going to apportion your income if you're a service provider by the percentage of time you spend in Mississippi versus the time you spend all over the U.S. Well, Equifax did not spend a lot of time in Mississippi, and so they had a very small apportionment factor and ended up apportioning very little income to Mississippi, even though they had decent billings from customers in Mississippi. Well, they followed the department's own regulations, and it comes pretty close to a zero tax return. The department didn't like the result. They said, well, you have customers in Mississippi, you ought to be paying some income here. It was really a market-based approach, even though percentage of time spent is more of an origin-based approach. They didn't like their own regulations, so they set their regulations aside and put Equifax on basically market-based sourcing and then imposed a penalty. And I find that offensive. Why penalize someone for not anticipating that they're following a statute is somehow going to be successfully set aside by Mississippi courts and the department upheld? You can't anticipate that, so why in the world would you ever want to penalize that situation?
North Carolina did the same thing in the combination cases, right? I mean, it is horrible that follow the law, you get penalized. It's scary.
It's like saying we penalize speeding, but we're not going to tell you what the speed limit is. We know it when we see it. So
I tried that defense last week, didn't work. No.
Shirley, can you?
Yeah, I think I would suggest that in the abstract, you sound perfectly reasonable.
Most of us usually do in the abstract.
In the abstract, right? But there are situations that states have tried to respond to using Section 18 where the distortion really didn't arise from special factual situations of the taxpayer, but actually arose from deliberate tax planning. And the state's just using Section 18 to address that. So in those situations, penalties might be reasonable. And I think it's best to perhaps leave that decision to the Administrative Review Board or the courts to sort through a challenge to whether or not penalties should apply on a more of a case-by-case basis. And I guess I'd raise the same point that I raised on the burden of proof, and that's just the question of these are valid issues. There are good points on both sides, but is the UDITPA the right place to resolve it? Is this really an issue for apportionment, and does it need to be uniform?
I just think in terms of uniformity, a taxpayer shouldn't be punished for conduct in one state that's not punishable in another state. I do deal on page 22 to 23 with Shirley's point about other penalties that could be imposed on tax avoidance, and my recommendation has nothing to do with those penalties. So if you have penalties that do apply to the use of tax shelters or doctrines like substance over form, transfer pricing issues, you could still impose those. Mine is limited to just if you followed the statute, you shouldn't be penalized for that. And I leave the door open for other situations. Now, this also raises the issue about retroactive revocation of alternative apportionment, that a taxpayer receives permission for filing under an alternative methodology, has structured transactions, made investment decisions based on that, and then the tax department revokes it retroactively. And you would say, well, that's a procedural issue. I mean, you could see this philosophical clash between what is appropriately within UDITPA and what is not. And I understand the philosophy. I just find it too wooden to have any appeal to the taxpaying public, which you're going to need support of. So anyway.
I guess the final comment on your penultimate comment was I've actually, I swear this is true, actually had at least one, maybe two auditors say over the last few decades, I don't care about the law. Your company should be paying more tax. It's a big company, and the law doesn't matter. And that's an extreme situation, but I actually did hear that. I think to some extent it pervades a lot of the audit function throughout the country. And that's why I keep focusing on the statutes, and I think there's got to be a return to the rule of law.
Business income?
That's a good point.
So I'll tee that up.
Mm-hmm.
Okay, so on business income, I think we chose business income not because there's so much that there's a problem with it that isn't being resolved, but because the resolution is completely different from what's in the current rule. So the idea is really to just reflect that this isn't, the model is not reflecting currently what the model drafters would really be suggesting that states do today. And the issues that we see that are being resolved are, first of all, whether there's one test or two in the definition of business income. So whether there's a transactional and a functional test, or whether the functional test is really just part of the transactional test, and a transaction has to meet both. The draft would resolve it by saying those are two separate tests. And then also this liquidation of a business question, cessation of business, and does the gain from the sale of a business, including a 338H10 transaction, can that be business income? And the courts have really come down and said no. And in a nutshell, I think the reason is that it's simply that how could it be business income if there's no longer any business? And so the draft would, that's a problem of statutory drafting. As a constitutional matter, I don't think that anyone would disagree really that that income could be apportionable income. And so the draft also says that that income is included as apportionable income to the extent that it is apportionable under the U.S. Constitution. Then it gives the transactional and functional test as examples of the type of income, the type of transactions that will give rise to constitutionally apportionable income. And I think the one other piece to mention, because people look at this and they don't understand what the draft is trying to accomplish, is that there's an exception to the constitutional test, and that is to deal with apportionable income, or excuse me, allocable income. Because, of course, allocable income, any income that under the Constitution could be allocated entirely to a state, the state would be constitutionally able to apportion that income instead and only take a piece of it within its tax base. And so we needed to specify that when we say that all income apportionable under the Constitution is going to be apportioned under this rule, we have to make an exception for income that could be allocated. And so that's what we were doing. And then we also make the corollary determination at the end of that paragraph to say that allocable income that a state does choose to apportion is included within that rule. So that states you do have some states that do choose to apportion income they could have allocated entirely to that state.
Can I take, this is the one on which I feel the strongest and have from the beginning. Rick and I did have the pleasure of talking about lots of these back in 2008 and 2009. And in general, I think that the things you like in his report, I'll take credit for, and those that you don't like, he fell off the trolley a bit. And this would be one of those a little bit. So my view on this is that, first of all, an awful lot of the cases that taxpayers have won and been very successful, good lawyering and all that stuff, they never should have won. Section 1 of the Uniform Law Commission's notes from the 50s note that property that was used in the business ought to give rise to apportionable income, or business income as it was known at that time. But that's been kind of missed, and in these extraordinary sales once in a corporate lifetime because of the statute. It was a very reasonable interpretation for the taxpayers to take and a reasonable conclusion for the courts to get to based on the language in the statute. So I agree it's a drafting error. It just seems to me as a matter of policy, the correct answer is states want an apportionable piece of everything that constitutionally they're entitled to, and that's what the draft now says. But then it goes on to sort of illustrate, well, what is that? And it illustrates it by using these same two lame descriptions from 50 years ago that we have spent decades litigating over what they mean and arguing about or and you know, what the meaning of is and things like that. So to me, it is completely pointless to keep that. We should just cut that old language and go as far as the Constitution permits, and a number of states have done that. States have reversed rulings of their own Supreme Court that decided in favor of taxpayers interpreting this language. Now, the argument is made, well, this will be guidance. I don't find the functional test and the transactional test guidance of any useful kind at all. And another argument is, well, people don't know what the constitutional limits are. Well, you have to know that anyway. I mean, if you're representing a taxpayer and you're trying to interpret the statute and you think the statute picks up more than the Constitution would permit, it would be dereliction of your duty not to try to figure out whether the state has gone past what the Constitution would permit anyway. I don't really think that's a problem. I think that there's an opportunity for a certain perniciousness on the part of taxpayers. It's how I make my living. Trying to find something that you meant to pick up with the language that says go as far as the Constitution permits, but I can argue that that language narrowed what you really picked up by the illustrative language in the statute. It just seems pointless to me.
I just have just 2 comments. I think the change in terminology is brilliant. I don't know how many times I have dealt with smaller companies, CEOs, and talk about business, non-business, and so it was very confusing, so I'm glad to see that. And the only comment I have on the functional test is a temporal issue. And we know that's an issue that Rick raised in his report also, that if an asset was actively used and directly used, I think that should be added, by the way, directly actively used in the business, and then it's retired and has a secondary. The usual example is a factory that the company's no longer using, and it's renting it out, and it's being used by a third party for a totally different business. How long that should be. Now, I assume that Shirley would say regulation or the discretionary authority. But even if it's going to be a regulation or discretionary authority to determine when an asset is no longer to be considered to have generating business income, there should be some standard, I think, in the model. Even if it's a qualitative standard, that people can apply actual facts to that qualitative standard.
All right, in response to Prentiss, I think there is utility in keeping, albeit cleaned up, the references to transactional and functional. I redrafted this sort of along the lines of Section 61 of the Internal Revenue Code, which says that gross income means income from all sources whatsoever, including but not limited to. I'm not sure you could make the kind of attack that you're suggesting here on Section 61, and so I'm not as concerned. I mean, we've got 2 great lawyers here, and yes, you give them an opening, they're going to walk through it, but it says apportionable income means all income that's apportionable under the Constitution, including but not limited to, and then we have these 2 tests cleaned up. I've made some tweaking. I think there is value to someone who's doing compliance work inside a corporation. They're not always lawyers, and if they are lawyers, they're not as enmeshed as the people in this room in constitutional theory and doctrine. Auditors, same thing. Many of them aren't lawyers, and if they are, they're certainly not enmeshed in constitutional jurisprudence. So I think it is useful to give them some guidance, and then as a political matter, you're going to be asking a legislature to adopt this somewhere along the way. And if it just said income that is apportionable under the Constitution, I could imagine a legislator saying, well, I don't know what I'm voting on here. What does that mean? What are the examples? What are you telling me? So I think it is useful, and I think as redrafted, I am less concerned about Prentiss's problem, although I'm always concerned if he's on the other side. So yes, you know, but I think it's pretty good. I took out the word regular from the MTC's draft under the transactional test. I think words like regular and I think words like directly just invite litigation. I don't think it's constitutionally required. And so my draft, I think, is a little less prone to being attacked than the MTC's draft, and I'm not sure I pay any price for deleting the word regular. I second Art's comments. To change business income to apportionable income is very good because, you know, as someone who tries to explain this to students and you say, oh, well, we have this concept of non-business income, but yes, it is the income of a business, it just adds to confusion, same as you've experienced. So I think it's very good, apportionable, non-apportionable, makes good sense. I deal with the temporal issue later, and it's a legitimate issue that you have an asset, it has been depreciated over time, and therefore those depreciation deductions have been apportioned to states, and it has reduced revenue. And now let's say you sell the asset and you are generating only tax gain. By that I mean all the gain is a function of depreciation you took. So you bought it for 100, you depreciate down to 10, and you sell it for 100. You have $90 of tax gain, which is being recaptured. And it ought to be given back to the states that bore the cost of the depreciation. You could do that, very complicated. You could do that by putting that asset on a schedular basis and taking a look at its life. Well, you know, that's way too cumbersome and we don't do it. But this issue will rear its head with respect to the numerator of the receipts factor. But it's a legitimate issue. Intertemporal considerations in state taxation are usually ignored. I think maybe the exception is installment reporting, where we worry about it a little bit there. But otherwise, I like what the MTC has done here. Prentiss is right that you can't be ignorant of the Constitution as a practitioner, so I'm not sure all of the controversy that this has led to is really appropriate. If you are going to conclude a transaction satisfies a statutory definition, you have to ask yourself, well, would that be constitutional? It's always the backdrop. But there was a big pushback on this. And Prentiss's camp, well, all you need is a reference to the Constitution. And I had exactly the other camp saying, well, as cleaned up, why do you need any reference to the Constitution at all? You've now cleaned up the definitions of transactional and functional. They reach everything. Well, they may reach everything today, but it's been 56 years since we changed this. Who knows how many years before we get a second crack at it? I can't predict where the economy is going to go and what new business practices will emerge. I want that constitutional test as a safety valve. So,
two comments. I assume we're going to talk about the recapture issue later on, or I'll see my comments for that. And I'm wondering if there are other people that are stupid as I am. Maybe not. Because when I saw the phrase relate to the operations, I never thought until I saw your comments it meant operationally related, which is the constitutional test. And if that was meant, maybe everybody else realizes it related to operations is identical to operationally related as an allied signal, then we're okay. But I would just say that I didn't realize it until I read further on in your comments, so you might want to consider that.
I think it's a fair paraphrasing of allied. So.
I'm the only stupid person. Could be.
All right, now the really controversial one, unless there's a question. I can't see with these lights, Chris. So.
I'm watching on not yet.
Okay, then the really controversial one. Not that these weren't controversial, but Shirley?
Okay. You want to start with section 17?
Yep.
Or? Okay. All right. So the really controversial one is, does anyone know? It's section 17, of course. And so it's the sales factor numerator sourcing for everything but sales of tangible personal property. And of course, in 1957, most of the economy was sales of tangible personal property, and not a lot of people really worried too much about sales of services and intangibles. And in fact, we see the drafters in 1957 saying things like, well, we didn't really get cost of performance right. The rule is income producing activity as measured by the cost of performance if it's multi-state income producing activity. But, and we expect frequent resort to Section 18 for taxpayers that fall under this Section 17 rule. But in those days, that might have been acceptable. Today, it's a different story. So much more of the economy is falling under Section 17. I think the last data I saw showed that for the service economy, for just the service economy, more than half of the jobs created in the United States over the last 10-year period came from service, the service sector. Intangibles, licensing of intangibles today, are the technology giants are licensing their software. That's what those receipts are. They're not sales of tangible personal property, they're licenses of software. That's a huge chunk of the economy. So they're now falling under these statutes that were really developed for the industrial age and admittedly at the time not very well developed for the industrial age. So this was the provision that the commission thought was really critical and drove the need to take on this project. because with the other provisions we're looking at, the states are moving away from the UDITPA rule, but they're moving away uniformly. On this provision, they're moving away from the UDITPA rule, they're moving away from cost of performance, and they're moving away uniformly in the sense that they're moving to market sourcing, which by some measure is what the sales factor is supposed to represent. But they're not doing it, they're not targeting market-based sourcing perfectly uniformly. You've got different rules. The bulk of those rules are, or the most popular of the market-based sourcing rules is the to source to where the benefits are received. And that's for, I guess, the entire rule. But the MTC did take a different approach. If you look at our rule, you'll see a couple of the features, the key features. The first is that it states right up front that the purpose is to source to the market. And the rationale for that statement is that we do have provisions that say if you can't follow the rule as it's stated, you need to make a reasonable approximation. So saying that our goal is to source to the market is telling the taxpayer what it is they're supposed to be reasonably approximating. The other thing it does is it tells us when it's appropriate to go to Section 18, and that is when there's not a reflection of the market. Then the rule's not doing what it's supposed to do. So that's why that's right up front. Then the next thing it does is it defines really how we're going, the proxies for the market, for chunks of the economy. Remember, with the income producing activity rule, that applied to everything but sales of tangible property. No rule is going to really address what's now by far the bulk of the economy well with just a single rule. So what our rule does is it breaks it up into four sectors. And the first two I'll do together. And one is the lease or license of tangible personal property. So not sale, but lease of tangible personal property. And then the other is the sale or lease of real estate, and those two are sourced to where the property is used. This just takes the long-standing MTC regulations and puts them in the statute. Then the next two are the big two. The next one is sales of services. So on sales of services, the question is, why not go to benefits received? Instead, we went with where the services are delivered. And I think the reason why we chose to go with where the services are delivered rather than benefits received, there are a couple of reasons really. But the first an observation, and that is that in a lot of circumstances, I would expect that will be the same place, that the benefits will be received where the service was delivered. So hopefully that in most cases that is the same place. But then why look at service delivered then? Because it's more from the perspective of the taxpayer. Rather than ask the taxpayer to figure out where its customer received a benefit, we're asking the taxpayer to look to where it delivered the product. And that's, so coming more from the taxpayer's perspective, should be easier for the taxpayer, but then also easier for an auditor 3-5 years down the road to figure out where the taxpayer delivered a service as opposed to where the taxpayer's customer received the benefit. So it's just probably a more administrable rule. And then I think that's...
Market potential.
Oh, right. The other, thank you. The other is that, well, the other reason why we went to delivered is that this is a sourcing rule for everything but TPP, sales of TPP. Sales of TPP are sourced to where the product is delivered or shipped. So this, at least this allows us not to have to distinguish between services and TPP in some circumstances, which is getting increasingly difficult to do. Now, then the final section, the intangibles, sales and licensing of intangibles. For sales, for both, the general rule is to source to where the intangible is used. But also for both, we define use in a couple of circumstances. With respect to the license of intangibles, we define use by, in terms of marketing intangibles. And those are trademarks that are, for example, that are used to market a physical product. So I'm not saying this is a marketing intangible, but just to give you an idea of what a marketing intangible might be, is a cartoon character, the license to use a cartoon character placed on a towel or a hat that then gets sold. If the license is to a manufacturer, the manufacturer puts that character in its product and then uses the character to market that product. That would be a marketing intangible. Others might be, for example, when you've got a sticker on the outside of your computer that says that you've got a certain type of software inside. Well, that might be the license of a marketing intangible. Those things have to be figured out. The definition of where that's used for that type of intangible, excuse me, is a look-through rule to where the ultimate consumer is, the purchaser of the product that the intangible is on. So that's a look-through rule. And then for purposes of sales of intangibles, we also define use in two circumstances. One is where the intangible is related to a geographic area, like a franchise. And if you sell that type of intangible, we say it's used where that geographic area is. And then the second type of definition for use in that area is the situation of the sale of an intangible where there's, an intangible where there's a continuing relationship with the purchaser, so that the purchaser can continue to pay, is not just, even though they've purchased the intangible, they continue to say to pay for the intangible based on their continuing use of it. In those circumstances, the intangible is treated like it were a license, just exactly as if it were a license, rather than a sale, because it is more like a license. The other thing to mention about the sale of intangibles is that any other intangible sold is thrown out of the factor. And the rationale for that is that once an intangible is sold, with the exception of those two circumstances that I just gave, the geographic area and the continuing relationship, then the taxpayer probably doesn't have much idea of where it's used after it's been sold. And so those are just thrown out with the two exceptions I gave. So the one other key feature of the rule is that a throw-out, is that we have included a throw-out. There's no throw-out or throw-back in the current income-producing activity rule. And maybe that's because it flows back to cost of performance. And cost of performance, of course, looks to right back, what are the costs of performance? It's the inputs to production. So it's the property and payroll. And where there's property and payroll, there's probably nexus. So that may be one reason why there's no throw-out in the current rule. Another is that 86-272 doesn't apply. So, because these are services and intangibles. But under the new rule, we're not looking at cost of performance. So we're not looking necessarily at where property and payroll are. We're looking instead at where the market is. And the question of whether there's nexus when all you have is a market in a state, while vast majority of the courts are answering that question as yes, it's still being litigated. And so we included the throw-out rule. And I think that covers it.
Excellent.
Yeah.
All right, I know you have reactions.
Oh, I guess two. Assuming we're going to go to market-based, which I understand we're following what states are doing, the marketing intangibles, when they're licensed to a manufacturer, and this is a very common situation, I think we can point out in your report, a manufacturer has a license to use that to make 1 million shirts. and the manufacturer then sells it to unrelated companies to wholesale then retail. And so the actual license is for the activity of manufacturing, even though it's a marketing intangible. So I would think that's where it should be sourced in a use concept and not try to do a look-through, not only because, as a practical matter, that data is not available, but it's not what the amount is being paid for. It's being paid for the right to put that on a T-shirt. The second comment, obviously, throw out, I still don't understand and never have understood why one state's decision or inability to tax something means, therefore, that more economic activity occurred in the first state, and therefore more tax should be paid to that first state. And so that's just a basic underlying problem a lot of us have with throw back and throw out, that it does not reflect what the Supreme Court has required. And I think it's good tax policy also that the amount of tax paid by a business reflects the amount of economic activity or value added that occurs in that jurisdiction. And throwback is antithetical to that principle.
Well, just a couple comments. The first one is that your point, Rick, at the outset about it's too bad that there's been a delay from when this project started. Nowhere is that more true than here, because on the difference between delivered, the rule adopted here, and benefit received, I certainly agree with Shirley that, first of all, I have no axe to grind one way or the other. I mean, either rule is defensible and either rule has a certain amount of problems. For me, the worst aspect is not having everybody on the same rule. So if we'd gotten to the table much earlier on this, perhaps we wouldn't be in the situation now where this rule goes to where the service is delivered and the largest state in the union has already gone to where the benefit is received. To the extent those are the same place, no problem. Example I have been using for years, ever since working on the Florida services tax back in the late 70s, where for use tax collection on services, the question was, where was the benefit received? And I say, I'm on my way to New York. I live in California. I'm on my way to New York to visit a client. I have a layover at O'Hare Airport and get a haircut in order that I'll look nice for the client.
Never.
Where was the benefit received?
It's not going to help. Haircut's not going to help.
Well, you were on my team then, and so the way was greased. Where is the benefit received? And there will be examples like that that are just very, very difficult. And so delivered does solve that in some of the cases, but there are going to be a lot of complexities on delivered as well. And there's certainly complexities on benefit received. So I wish we were only dealing with one set of the complexities rather than the over or under taxation that's going to occur because we have differences, especially when the biggest state has a different rule than this proposed rule.
You know, to that point, I think that that this is a period of transition where states are transitioning, and so you do have to identify the trend, and you do want to. It should be good tax policy, as Art pointed out, but also you want to, within the realm of that good tax policy, you want to move forward, not backward. And so I think that in this situation, with the delivered, at least I think that it's compatible with the benefits received rule. It's a market-based sourcing rule. And so I think that it's...
yeah, I'm not arguing that you should have gone to benefits received. I think the rationale for going to delivered makes perfectly good sense. So maybe this is just I'm wasting time. I'm simply lamenting that we are in this split between some states, including the largest, and the direction we're going for the others. I think that's too bad.
And I agree with Shirley that, I mean, the idea of delivery is something that the taxpayer knows. So even though it might be the same, conceptually it's better to have delivery. But once again, I hate to be redundant here, but I think the statute or the model should be fleshed out to describe what delivery means in so many different situations. And I think leaving to regulations, again, is deferring too much to the executive branch of government. I think, for example, a digital good or software that's sold to a corporation, and I'm not sure what the right answer is, but it should be spelled out so at least we have uniformity so you don't have that greater risk of multiple taxation.
Let me defend the drafting judgment call by the MTC, although it makes it difficult to evaluate the draft. It's a very creative draft, it has a nice structure, and they made a drafting judgment call that key terms will be defined in the regulations. Now, I happen to like that because I think the key terms should be defined in the regulations industry by industry, because I think a term like delivery or use or marketing intangible may have a different meaning depending on the type of transaction or the kind of industry. So I like that judgment call. It also meant, on my part, it was very difficult to evaluate the draft because there really was no guidance. And I would say I was pretty harshly criticized by a dear friend of mine in state government who's watching today as an anti-MTC bias. And all I can say is, look, my role is that of a kibitzer, and it's easier to kibitz than to draft. We all know that if you've done both. And so it was rather easy for me as a tax lawyer to go through the draft and raise a series of problems. Problems as simple as I am a lawyer, or I guess what do I use because we want to keep away from law firms, a architectural firm, and you're my customer in state B, I'm located in state A, the project's in state C. And does delivery have a different meaning if I visit you and hand you the plans? You come to my office, I hand you the plans in my office, I send it by way of email attachment and you download? I mean, what do we mean by delivery? Well, the regs will sort through that. But it was certainly easy enough to raise these hypos, and I think people agree, those are things that we have to worry about. So I have trouble evaluating what's here until I see the devil is in the details, and I want to see the details. Now, I hope the report is useful in providing areas that the drafters of the regs might think about. But because there's a parade of horribles here, it doesn't mean that they will materialize in real life. I hope they don't. I hope I have really exaggerated, perhaps. But the answer to whether I have or not might well depend on the state and may well depend on the regulations. Key terms are not defined. Use. Oh, that's a hard one to define. Intangible is not so obvious either. Marketing intangible. Art gave a hypo that's very familiar with ConAgra, right? Mm-hmm. So we have a whole bunch of situations. I don't know how they're going to come out. That's, I guess, one of the major sources of controversy is people said, well, I'm reading the draft. I have very common situations. How do they come out? I can't tell. And I agree, but presumably that's where the regs will intervene. Now, Massachusetts has adopted the draft, and Alabama has adopted the draft. I've also been told there's no litigation, so of course everything is working fine. I think it's probably too early for there to be litigation. And I also have been told by practitioners that things are just slipping through in the returns, that people are doing what they want and it's not being caught, at least not now. Marketing intangibles. You know, I have a problem because the draft, your draft, the MTC's draft, seems to assume that when you license an intangible, you will have perfect information about where that intangible is being used. I think that's true about Disney, it's true about Nike, but it's certainly not true about a whole second level. I mean, you take, let's say, Chris, one day you were to license, maybe you do, the tax analysts sweatshirts and t-shirts and coffee mugs. And there are lots of companies that will be happy to represent you on this. I don't think you will know where things are sold once you license them and they take it from there. There was the sense, well, gosh, you can audit the amount owed to you, and therefore that will provide the information. Well, I looked at a bunch of license agreements in cases I've been involved in. Yes, the licensor can audit the sales to make sure that a royalty will be accurate. But for that, all you need to know is sales. And that typically is audited by looking at financials or the tax return. You don't need this next level of breakdown by geography, sales where. So again, I think, like usual, the world divides into two camps, those for whom the marketing intangibles will be easy to apply and many others, and I don't know whether we're talking a serious problem or not. I don't have enough information, but I do think it's an issue. The throw out rule always provides possible constitutional issues, which is why I think New Jersey abandoned it. I understand you can't throw back in this area as easily as you can with tangible. Yes, I acknowledge that. Throw out just has quirks to it, has eccentricities. New Jersey adopted it, and they were the ones that really brought it to prominence. And again, the interest of disclosure, I really work with them on this. They couldn't get a throwback rule because of the drug companies based in New Jersey. They have structured their life around Public Law 86-272. Throwback was untenable. And the governor said, what else is there? Well, there is a throw-out rule. It's not great. And we have since seen that in litigation in New Jersey. It's not great. But they couldn't do throwback. I'm afraid no matter what, at the end of the day, you still have this definitional problem of something being tangible and something being a service or intangible. Because 17 does not track fully Section 16. 17 has reasonable approximation rules. It has throw-out rules. It has rules that a taxpayer might like and want to be in 17, might not like and want to be in 16. And then when we get to the numerator of the receipts factor, this characterization issue rears its head again. So what is worth just making a note of, because it's going to become relevant shortly, and how much time do we have, Chris?
We're still good. We got about 20 minutes.
20 minutes. That the receipts from the sale of intangibles are thrown out. And so that will include the receipts from the treasury function. Now, I guess everyone in this room knows the treasury function, but people watching may not. And this is where the company, at the end of the day, has excess working capital, sweeps it all up to the parent, where you have a CFO who has some expertise in investing in the overnight market, does so, and so they buy commercial paper, they sell it, and they get this big gross receipt. Does that go into the receipts factor? And here in Section 17, that situation is addressed, although indirectly, and what I have learned is that no one really focused at the time on the treasury function. They dealt with that later, as you're going to see, and I have problems with it later. This is a response, although not explicitly and not intentionally, to the treasury function issue, because the receipts from the sale of the commercial property, commercial paper, would be thrown out as a receipt from an intangible. It also covers hedging, which again is a problem that is addressed later, I think better handled here. Anyway, the bottom line is I raised problems. I think they're legitimate problems. You could quibble with me by saying they're not going to be real, serious problems, and that may well be. I will be the happiest person if that turns out to be true, but I just don't know that it's true, and I certainly wasn't doing MTC bashing by performing my job of identifying problems. So I do have something in here about revisiting cost of performance that Art mentioned before. This is the current Section 17 rule. It's an origin-based rule that we assign the receipts from services and intangibles to the state that has the plurality of costs. It's an all-or-nothing rule, and people don't like that feature of it. Anyway, having litigated a couple of these cases, I have provided areas where I think the cost of performance rule can be improved. And I'm not naive enough to think this is going to change the MTC's thinking and move them back to cost of performance. No. But this is for the states that now have cost of performance, or states that may become disenchanted with market-based sourcing, which is possible if they screw it up. They may really be disenchanted. The revenue may not be there that perhaps they were hoping. And so there is a piece here on revisiting cost of performance, but it's not because I really think anyone's going to turn the clock back to this origin-based rule.
Rick, one question I have for you and Shirley. Reasonable approximation, it's really a question. What does that mean? Does that mean if the taxpayer on its return takes position that's reasonable, it's upheld, or if the tax administrator has a different position that's also reasonable, that would prevail? Is that clear, or is that just a procedural question we'll let people fight out?
The regulations.
Yeah.
It's for the regulations. Right.
Let me jump in here. Note that the coffee mug at Tax Analysts is, like many things at Tax Analysts, a thoroughly nonprofit venture. We have a question back here, I think. Comment? The time has passed? I'm sorry, I tried to get to you. All right.
Time has passed like cost of performance.
There's a question.
Where? Oh, over here?
It's an IMF. You've certainly demonstrated the complexity and difficulty of doing formulary apportionment amongst the states. As I'm sure you're aware, there's a great deal of concern now also among tax evasion at the international level. And some have suggested some form of formulary apportionment between nations, both within the EU, but also more broadly. I was wondering if you could comment on the workability of that.
Yeah, I have a very simple solution, and that is to define the domestic combined group in those states that have combined reporting, and states ought to have it, to include tax havens. You simply expand your notion of who's in the combined group to cover tax havens. And then you have your list, and that will make that problem go away. We can't wait for Europe to take a lead in this because that's going nowhere fast. So,
do we have the states make their own decision as to what other countries are tax havens, Rick?
the MTC is quite capable. You know, there's a core group. You wouldn't disagree that Nauru, known only to stamp collectors, is a tax haven. And then the classic ones, Ireland's the tricky one. But Montana brought Ireland into their tax haven group, and I think had a visit from the ambassador. So be good. Get the Irish ambassador to your state, you know, drink some good beer, single malt whiskeys, be fun.
But if you're referring to the talk in the international community about abandoning residence income and credit and going to apportionment, which there's a lot of press, especially in Europe, about that. And I know, I believe the U.S. government so far is withstanding that. I'm not really sure, it's not my area, but I did speak with somebody, an international tax lawyer, and they were talking about these proposals, and I said, well, what's going to be in the factors? How are you going to source it? Oh, we don't know that detail yet. But I think the takeaway from all this is devils are in the detail. If it's done on an international basis, these things have to be ironed out very clearly in the treaties, I think, and not left to competent authority, for example. Every little detail, I believe, should be in the treaty.
Yeah, what I'm suggesting would not violate any treaty, and we should have done it yesterday, so.
Right. I agree with Art and Rick, and I think that it's what you're comparing it with. And compared with what you do now on the residency-based taxation and the need for arm's length, looking at arm's length pricing and arm's length transactions, that formulary apportionment is a rough approximation. The idea is to apportion the income that's hard to source using some kind of activities that are easy to source or easier to source. So it just should be, it's a proxy, it's a rough approximation, and I think a much easier way to do things than actually trying to investigate transactions and use under the residency approach.
I mean, I was astounded that our hearings on Apple turned into a love fest. You know, you start off with, what's this international tax minimization, and then everyone's waving their iPhones, and they'd get them autographed if they could have gotten them autographed. So
in the UK, they had similar hearings. They had Starbucks in front of them, but I don't know whether it was a love fest. I know Starbucks agreed to pay $20 million over a period of, over a couple of years as a result of those.
What I
And this
drink in
area has an
cappuccinos.
acronym now, right? This is what they're calling BEPS, I think, base erosion profit shifting.
Profit shifting, yes.
Yeah, and
Receipts.
so, I mean, I understand the problem. It's been around before. We've had some earlier flirtations with whether formulary apportionment is the nirvana solution to 482, which is certainly an intractable problem. And
Actually, it passed one house of Congress, didn't it, in 1940s? 1940s or 30s. I thought one house before they went to 482 was talking about that, or maybe one of the treaties.
It was in the 70s. I think you're right, in the 70s.
Something, and so it's been looked at before, yeah.
You know, one point when you talk about the devil being in the details is that I think an observation is to think about where are the problem areas. And of course, this whole panel is about the problem areas. So, you know, don't let that get out of focus. But also, with respect to Section 17, which really is the main problem area, there's really, in my opinion, not so much of trouble, even market-based sourcing, when the taxpayer is selling to a natural person or an in-state only entity, business. The issues where you have the problems, the issues come up is when the taxpayer is selling to a customer and the customer itself is a multi-state entity. And then it's hard to know, where is this thing being used? It's not necessarily in any one state. Or where is the delivery? Because it may actually be, we're not going to use, I don't think, an email delivery to define delivery. So where is the delivery when the customer is spread out over multiple states?
It's a good point. With individuals, you have the model of the Mobile Telecom Sourcing Act, which took a shortcut to do sourcing for an individual, although the individual may in reality be using property or service in multiple jurisdictions. In the long run, it's all going to equal out. Let's make it very municipal. Let's pick one. So I think you're right. There's a big distinction between a customer being an international or multi-state business compared to individuals.
With one caveat, if the provider is multi-state, it allows for the manipulation of a delivery rule should the dollars be worth it. So.
And the intractable problem for the audience that Prentiss was talking about is transfer pricing. And 482 is code for that, just so we're all on the same thing.
Move on.
We got about 10 minutes.
Receipts factor then, Shirley?
Okay, just real quickly. The main change in the receipts factor is easy. It says sales is defined as all gross receipts. So we're talking about the sales factor. How do you define sales? And remember that this applies to both Section 17 and Section 16. So it's both. And the current definition, all gross receipts. What the proposal is to take our reg that's been in place since 1973 and move that into the statute. And what the reg does is it defines all gross receipts that are, I'm going to paraphrase, but that are associated with transactional income. And transactional income, and remember, as opposed to functional income, transactional income is transactions and activities in the regular course of the taxpayer's business. So these are the sale of the taxpayer's product to its customers. Functional income, which is not included in that definition of sales, the way we would have it, functional income is the sales of a property that is used in the operation of the business. So it's the production equipment, the land, the factory, the land, production equipment, production intangibles, investments that finance the operation, but they're not sales to the customer. The goal, our goal, is to define sales more narrowly so that it reflects the market state and not the production. So thereby just use the transactional test in related receipts and not functional test related receipts. That's the goal in a nutshell. Yeah, and the other thing we do is of course, treasury function meets the transactional test. So we specifically remove treasury function. Now, if all you're worried about with treasury function, that's the overnight investments, say, of a taxpayer's working capital, it can really build up the denominator, causes a distortion problem. And if all you were worried about was the distortion problem, you could solve it either by removing the treasury function receipts or by including them, but just at net. On the other hand, if you're concerned not just with the distortion problem, but also with the question of, well, how do you source those? Or the issue of, do sales or do treasury function receipts really belong in a sales factor if what you're trying to reflect is the sales the market for the taxpayer's product. So if you have those policy concerns or sourcing concerns, then the better approach is to just, the thought is that the better approach is to just remove them from the factor altogether. And so that's what we've done.
Well, I don't feel too strongly about this, other than the narrowing definition of sales, the obvious point, and you make it in the report, is, gee, I thought what we were apportioning is income, not just income from marketing. And so we've narrowed it down now to look at just marketing and knocking out the treasury function and the hedging. I also, in my own mind, there remains a sharp distinction between the treasury function and hedging in terms of how central to the business it is. And I also have a more, I suppose, generic. Those have been dealt with by the cases. The states have done fairly well in dealing with those. And, you know, issues like this, it seems to me, are going to come up, and some things will be litigated. So to narrow the definition of the word receipts and take on certain specific issues that are current issues today and you'd like to have resolved, I'm not sure this is the right place to do it. So I would have preferred not to have done it here.
And I would comment on the first of the two things you spoke about, Shirley. In other words, as I understand the proposal, gain from the sale of functional assets would not be included in the receipts factor. And I think that's wrong for a couple of reasons. One, first of all, if the gain is in the income base, then the factor that generated that should also be the apportionment. And Chief Judge Cardoza of the New York Court of Appeals, like 30s, 20s, you know, talked about that reflection is necessary. Now, some people will say that, as Rick was saying earlier, let's use the example of a factory that was purchased for $100. And over 10 years, that factory was depreciated, $10 a year. And so the operating income was lowered, okay? Well, then the company sells that to some unrelated business for $100. Well, the point is that $100 is going to be recaptured depreciation, say for federal purposes, but that amount realized is not because of the activities of the company for all the prior years. The gain of $100 is not because of the current operations. So the current factors should not be used to apportion that gain. That gain is because that building has retained its value, even though it was used as a productive tool for 10 years, and the original investment was all used up. The only reason it's worth $100 now is because it has intrinsic value because of where it's located or the nature of the property, how it's maintained. So I would think that should be in the factor and should be sourced to where that real property is located and not totally disregarded. I think that would apply to almost all functional property. And disregarding, I think, is also not only for policy reasons, but would also be constitutionally suspect because the Supreme Court has said that the factors must reflect where the income is earned.
Yeah, I certainly agree with that. I think it is bad precedent to exclude from the receipts today's current problem, as Prentiss said, hedging treasury function. I worry about the lobbyists coming in and saying, hey, I'd like something excluded from the receipts factor too that's in favor of my constituency. I just think it is a Pandora's box and is unnecessary because Section 17 already throws out these receipts. I don't know why we have to do it and pay a price for doing it in the receipts factor. It's sort of a dilemma here because there's quirky situations whether you include the gross receipts, exclude the gross receipts under the functional test. You're going to have a Section 18 argument on your hands. In some situations, I don't think there's much you can do about it. What I don't like is that this reintroduces or puts pressure on defining transactional to get the rules right. Because if it's transactional, you're in the receipts factor. You may like that if you are trying to apportion a loss. You may want to pump up that numerator. It reintroduces pressure on getting tangible versus service right because services aren't in the functional test. They are in the transactional test. It reintroduces all the potential for tax planning that I thought we were getting rid of under the definition of business income. So it reintroduces it. I think we pay a price for excluding specific categories like hedging and the treasury function. I have offered two alternative drafts. I don't think there's an obvious right answer here. And there is an old reg that the MTC has had about excluding substantial amounts of gross receipts from an incidental or occasional sale of a fixed asset, the so-called factory regulation. And that was to deal with this problem, I think, of skewing the receipts factor with a one-time large gross receipt from assets that have appreciated over time or depreciated, like a factory. That reg, which has been around for, what, 40 years, 50 years, has not led to any litigation, which I find odd. But when you shepherdize the terms or put them in Lexis, you don't find any real litigation.
And that's because the administrators know they're wrong, and we've settled, I don't say dozens, yeah, probably a couple dozen in my career on that reg. Saying it's unconstitutional, and we would settle on it. That's why you haven't seen any published cases.
Or maybe they think the reg applies to your situations.
Well, there are times when there's an asset sold that we think the gain should be in there. If the gain is in the income base, then it's got to be in the denominator of the factor.
I've not had as good luck in California. You're just obviously a better lawyer than I. I've had this this exact situation in which, in some cases, 100% of the income for the year was from the sale of the factory, as we're describing, and the notion that it's not in the receipts just seems plainly wrong.
And you could end up with a 0 over 0 in that case, can't you?
Infinite tax.
Which, as a matter of mathematics, is infinite, but under this draft is 0.
Yes,
But why not define math the way you want? So
that's true, and there are circumstances where there would be distortion. There are always circumstances with any rule where the result, you could come up with a result that's distortive. But I think in general that you got to remember that those receipts from the sale of that property are reflected in the factor if the factor includes, if in the formula, excuse me, if the formula includes a property factor. The idea with the receipts factor is that it's supposed to reflect the market. The property factor is to reflect the property. So part of the rationale for pulling those out is so that you're not double counting the property factor. Now, I will say that if you've got a single sales factor, and because of what we've talked about, the narrowness of that sales factor, then you might want to go ahead and include all gross receipts in the sales factor so that you are including the reflection of property somehow, at least. But if you've got a property factor, I think that takes care of it. And remember that it is in the pool of income to be apportioned. It is apportioned by property, payroll, and sales, and that no factor, no formula is going to include all the activities. The sales factor doesn't, in my opinion, in the opinion of the Uniformity Committee, doesn't need to include all sales.
All right, but the market, I've seen you say that there's no market, but there is a market. The person who bought the factory or the person who bought the drill press. So there is a market for that transaction, and that, I think, should be reflected in the denominator. Never the numerator, just the denominator.
And you would agree, yeah. And you would agree the Supreme Court has never endorsed your or the Uniformity Committee's view of the sales factor. You can't find any statement by the U.S. Supreme Court, this is how they view the sales factor.
Well, actually, I'm a little confused by the idea that a factor has to include all of a particular type. The U.S. Supreme Court has endorsed the three-factor formula, and you got to remember that the three-factor formula does not include all activity, and for example, and not even the factors include all of the type of product or activity in those factors. But property factor doesn't include intangible property, and I think there's a rationale, whether the committee wants to go with that or not, but there is a rationale for not including all sales in the sales factor.
I doubt that when Containers said the three-factor was a benchmark, it was thinking, oh, and we're also including the exclusion of receipts from the functional test in that statement. Right. So the Supreme Court did say that the factor has to rationally, reasonably reflect how income is generated, and I think you are asking for problems.
I do appreciate Shirley's acknowledgement, though, that there will be distortion in these cases. I fear the gap between Shirley's acknowledgement and the Departments of Revenue also agreeing. It's that gap that is our problem.
I'm going to have to bring this terrific conversation to a close because we've hit our time. Let me just remind everybody that in another totally nonprofit venture of Tax Analysts, anybody who wants a free print copy of the report, you can get it from taxanalyst.com, and we'll take care of it. Let me thank the Tax Analyst staff, who once again did a terrific job. Let me thank you all for coming, and let me thank this fantastic panel. This is the easiest one I ever did because I just got to sit here and listen to these great folks. So let's give them a round. Thank you.